So let's look at an example now. If the parent has been using the equity method and it is in the year of the acquisition, how to do consolidation. So this is the consolidation worksheet. And the first column here is taken from what we did in last class. So basically this consolidation worksheet, so first of all, we have 6 pages which represent 6 scenarios. And then the first column of each page, that is the parent book. Each of those columns are taken from each of the 6 columns from last class. So that in last class, we talked about if the parent has been using each of the 3 different methods and whether it is in the year of acquisition or subsequent to the year of the acquisition, how the parent book will be different. And in today's class, we just take those 6 columns and we make them, each of them, the first column in each of the 6 pages here, 6 worksheets here. And then we begin from that to do the consolidation. So the first page, that is if the parent used the equity method and if it is in the year of acquisition. So first, just as a kind of like a review of what we did in last class. So first of all, one thing you should pay attention is the parent book, because the parent has been using the equity method. So this 93,000. Do you still remember how we get this number? Yeah, that is 100,000, which is subsidiary's current year income, minus 7,000, which is the amortization. So that will give you 93,000. And then the investment account, the consolidation entry S, the purpose is to eliminate subsidiary's shareholders' equity account. So subsidiary has common stock 200,000. To eliminate it, we debit 200,000 common stock. Subsidiary has additional paid-in capital for 20,000. To eliminate it, we debit 20,000 additional paid-in capital. Subsidiary beginning retained earning is 380,000. To eliminate it, we debit 380,000 beginning retained earning. And 200,000 plus 20,000 plus 380,000, that adds up to 600,000. So we credit investment account for 600,000 accordingly. Consolidation entry A is to mark up subsidiary's book value to fair value. So if you still remember, subsidiary has a trademark. The difference between book and fair value is 20,000. Patented technology, the difference is 130,000. Equipment, the difference is negative 30,000. And then we also have a difference, which is coming from the goodwill, which is 80,000. So if you add them up, investment account goes down by 200,000 accordingly. Consolidation entry I, the purpose is to eliminate subsidiary's income recognized by the parent. So how much of subsidiary's income is recognized by the parent? Yeah, so it's 93,000. We use consolidation entry I to eliminate this account. In order to eliminate it, we debit 93,000 and we credit investment account for 93,000 accordingly. Consolidation entry D. So the purpose of consolidation entry D is to eliminate the dividend, the intra-entity dividend payment from the subsidiary to the parent. And then the journal entry, we already explained it. So it is to debit investment account for 40,000 credit dividend declared for 40,000. Consolidation entry E. Consolidation entry E is to do the real amortization because the parent kind of paid the difference between fair and book value here. So the parent, so the book value of the subsidiary's asset, it is amortized or depreciated on subsidiary's book. And then once the parent is paying the difference between book and fair value, it is like revalue the asset to its fair value. So book value is either amortized or depreciated on subsidiary's book. So how about this difference between fair and book value? We also need to either amortize or depreciate it. And it is not done on subsidiary's book. That's why we need to use consolidation entry E to either amortize or depreciate this difference in value on the consolidation worksheet. So this part needs to be taken care of as well, and we're doing it on the consolidation worksheet. Specifically, the difference, the trademark is not amortized. Patented technology amortized over 10 years. So each year, the amortization is 13,000. And this is amortization. This is an amortization expense because patented technology is an intangible asset. And then we also have equipment. The difference is negative 30,000 depreciated over 5 years. So 6,000 is actually it is decrease in its depreciation expense. So 6,000. So that's all for consolidation entry E. And then the next step is to do the consolidated total numbers. For all of the income statement accounts, we just add them up horizontally. So total revenue is 1,900,000. Cost of goods sold, 900. And then if you add them up vertically, that will give you 693,000. And then this is carried over to your statement of return earning. On the statement of return earning, your return earning beginning balance is 840,000. Dividend declared is 120,000. So your return earning ending balance is 1,413,000. And this is carried over to your balance sheet. On your balance sheet, current asset adds up to 1,440,000. Your investment account will go to 0. Trademark is 820,000. Patented technology is 775,000. Equipment is 446,000. Goodwill is 80,000. And then if you add them up, that will give you 3,561,000. The liability and shareholders' equity side, liability, total liability adds up to 1,428,000. Common stock, sorry, that is negative. Common stock is 600,000. Additional paid-in capital, 120,000. And then your total liability and shareholders' equity adds up to 3,561,000. So this finished the consolidation process. And there are several things I want you to pay attention to. First of all, after you have finished the consolidation, there's 3 things you need to check. The first check is your equity in subsidiary earnings. This account should go to 0. If it is not 0, there's something wrong. So you need to check for this number. The second one is your investment account should also go to 0. So this is check 1. This is check 2. And the next thing is your total asset should be equal to your total liability and shareholders' equity. This is check 3. If they are not equal, there's something wrong. And there is specific to this situation, which is if the parent is using the equity method. There are also some places that I want you to check. So what can you find? If the parent is using the equity method, the parent's net income, actually, it would be the same as the consolidated total net income. And the parent's retained earning will be the same as consolidated total retained earning. The parent's shareholders' equity account, its common stock, additional paid-in capital, and retained earning at the end of the year will be the same as consolidated total common stock, additional paid-in capital, and retained earning at the end of the year. So this is actually the situation. It only happens if the parent is using the equity method. So that's why it is the advantage of using the equity method. If the parent is using the equity method, it can just look at its own net income. And without doing the consolidation, it will know what is the consolidated total net income. You are not going to find this if the parent is using either the initial value or the partial equity method. This only happens when the parent is using the equity method, and this is the advantage, the major advantage of the parent using the equity method. And the parent can also just look at its retained earning, look at its own retained earning, and it is going to know what is going to be the total consolidated retained earning be without doing all of the consolidation. So this is some place that you should pay attention to. And then before we finish talking about this example, there is one last place that I want to explain. So actually this check 1 and check 2. In check 1, I ask you to check for the equity in subsidiary earnings. This should go to 0. And do you know subsidiary net income recognized by the parent, it is reversed by consolidation entry I. That's why after consolidation, you shouldn't see any equity in subsidiary income. So it's similarly for the investment account recognized by the parent. In this investment account, how is this reversed in the consolidation process? So this 800,000 is the initial investment, right? What is this 800,000 made up from? It is made up of the net book value of the subsidiary, right? Plus the difference between fair and book value, plus goodwill, right? That is the initial investment. And then we add the current year net income minus the current year dividend, because this is only the first year, and minus the 1 year's amortization. And then if you look at it, your net book value, this is reversed by consolidation entry S. The difference between fair and book value and the goodwill, this is reversed by consolidation entry A. And this current year net income, minus amortization, this is reversed by consolidation entry I. And finally, this 40,000 dividend is reversed by consolidation entry D. So that's why after the consolidation process, your investment account should go to zero. If it's not zero, there's something wrong. So this is all I want to talk about regarding a first situation. If the parent is using the equity method and it is in the year of the acquisition. And then we're going to look at if the parent has been using some of the other methods.